Big announcement. Last week, the government came forth with a lawsuit. The Department of Justice announced an antitrust lawsuit against Apple. The stock is down 5%. It's lost $150 billion of value since that announcement. So, is this a buying opportunity for this Mag 7 star? Tune in and find out. A few key things to know about Apple, guys. Foreign exchange has had a major impact on Apple, with 64% of its revenues coming from outside of the United States. Now, question we have to ask, how might China be messing things up for Apple? In the cash flow statement, I'm going to show you something Apple is doing with share repurchases that I have never seen before. What impact is this US government lawsuit going to have on Apple? It's specifically targeting smartphones, of which that's 52% of their revenues. Now, Wall Street has Apple with a fair value of $200 per share. That's an 18% premium to where it's currently trading, but with a high of $250, which is 50% upside, and a low of $125, which is 25% downside. Now, I have spent the last week building a financial model with 3 scenarios, analyzing the impact of the lawsuit to answer the question, can you make money by investing in Apple today? All right, guys, first thing that we have to discuss, the balance sheet. Cash and marketable securities for Apple is $162 billion. Just to give you perspective, the largest hedge fund on planet Earth, Bridgewater Associates, they have $124 billion in assets under management. Asset has 30% more than that in cash. Also, for those of you who like tech stocks, Block, Supermicro, Palantir, Apple could literally buy all 3 of those companies and still have cash left over. Now, the debt has remained flat. They have very low leverage. Only 4% of their total capital is debt. And we don't see debt increasing with their revenues going up. Also, retained earnings has decreased, but there's a very good reason why. We're going to see that in the cash flow statement. What's the punchline here? They're very conservatively financed. They have a solid balance sheet with a AA+ credit rating. Let's hop in the model. A few key things that we want to focus on. They have cash and marketable securities of $162 billion. That is just absolutely mind-boggling. Despite the fact that they've increased their revenues, they haven't financed it through debt. Debt has remained relatively flat. Also, if we look at retained earnings, we see a decrease in retained earnings, but there's a very good reason for that we're going to see in the cash flow statement. Next thing that we have to discuss, the income statement. Now, over the last 3 years, revenues have increased 40%, but they're down about 3% last year. We're going to get into why. Interest income is covering interest expense, so that's ultimately a push. And they also show efficient control over expenses and taxes. Now, revenues have grown 40% over the last 3 years, while net income has grown 70%. This is indicative of positive operating leverage. Revenue is what you make, net income is what you keep. But a couple things to be mindful of. In terms of the decrease in revenues, China is about 20% of total revenues, and they've displayed declining growth over the last several quarters. Also, foreign exchange has really hurt the company, with 64% of their revenues coming from outside of the United States. All right, guys, the income statement. A few key things to notice right here. Number one, looking at revenues, we see over the last 3 years a growth of almost 40%. Really impressive, but that's counterbalanced with a decline of about 3% over the last year. We talked about the impact of China and FX. Interest income is basically a push relative to interest expense, which is a tremendous positive. And then lastly, what we see is about a 70% growth in net income over the last 3 years. The company has really good control over its expenses, and it's able to increase revenues without a corresponding increase in expenses. This is really, really good cost control. We love to see stuff like this. All right, guys, next we have to talk about the cash flow statement. We've seen a 36% increase in free cash flow over the last 3 years, driven primarily by net income. The company has done $392 billion of share repurchases over the last 5 years, but wait until you see how they've accomplished that. It's truly remarkable. Also, this company is a cash machine. Cash is projected to nearly 20x over the next 5 years at the end of the model. And with over $160 billion in cash and marketable securities, Apple can buy companies, plow it into R&D, or return it to shareholders. Let's hop in the model. Some major things to note here from the cash flow statement. Free cash flow has just been absolutely ripping over the last 5 years. Some really impressive numbers that we see here. Lots of growth. Also, I mentioned the company doing share repurchases, and there's a very unique way that they've been accomplishing this. So they've bought back $392 billion of shares over the last 5 years. Now, how have they done that? With all the cash that they've invested in basically money market type securities, think treasuries, repurchase agreements, commercial paper, etc., they've generated $437 billion of cash flow from the cash that they've invested. So 392 billion has been repurchased in shares, and that's been offset by 437 billion that the company's made just from investing their cash. I've literally never seen anything like this over the last 20 years. It's truly remarkable. If you look out several years here, we have about 30 in closing cash, so not cash equivalents, just cash, and that ends up ballooning to almost 567 billion in the next 5 years, which is just absolutely bonkers. Okay, guys, next thing we're going to talk about are the forecast drivers. So these are going to be the pieces that are going to create the projections, the future numbers in the model. A few things to note. Cost of goods sold has declined as revenues have increased. This is indicative of great cost control, high bargaining power over their suppliers. The savings from cost of goods sold has allowed the company to increase their research and development, which is fantastic. Also, they're very, very efficient from a tax perspective with an effective tax rate of about 15%. A few things to note here. If you look at COGS as a percentage of revenue, it's actually decreased over the last 5 years. Now, COGS stands for cost of goods sold. That's basically what they're spending on all those physical products that they ultimately produce, smartphones, iPads, etc. But what they've done is genius. They've actually been able to increase their research and development over the same time frame. So the savings that they're getting on COGS, they're actually redeploying in R&D. Truly remarkable. Also, the company's really been super efficient from a tax perspective. They've had about a 15% average tax rate over the last 5 years. So regardless of the fact that they're making so much more money, they're still able to keep a lot of control over their taxes, making money in foreign jurisdictions using tax credits, etc. Really, really remarkable stuff that we're seeing here. If you're enjoying this, please smash that like button. All right, guys, next we have to discuss DCF or discounted cash flow assumptions. Now, beta is relatively high, but it's not that bad for a tech company. Remember, higher beta gives us higher weighted average cost of capital, which is the discount rate for those future cash flows. The company has low leverage and a AA plus credit rating. Remarkable. When including long-term marketable securities, they are net cash by $65 billion. So if they literally paid off every penny of debt that they have, they'd still have $65 billion of cash left over. Now remember, conservative assumptions equals conservative results. So that's something we always want to focus on when we're building our financial models. Let's hop in the model. All right, guys, DCF assumptions here, really important. We're running 3 scenarios. We have a bear case scenario, which is a downside, a base case scenario, which is steady state, and a bull case scenario. So for the bull case, revenues go up, costs go down. For the bear case, revenues go down, costs go up. Base case is steady state. Now, in terms of the DCF assumptions, we have a 5-year risk-free rate because it's a 5-year model. Beta works out to be 1.25, which actually isn't that bad when you consider tech companies sometimes have upwards of 2. Also, we have the market risk premium, 4.13, for a cost of equity of about 9.5%. Because they have such a high credit rating, they end up having a very low cost of debt. The spread over treasuries is only 70 basis points or 0.7%, which gives them a really low cost of financing. 20% effective tax rate, post-tax cost of debt of about 4%. We have 4% debt as a percentage of total capital. We end up getting a weighted average cost of capital of 9.3%, which is actually very reasonable for a high growth tech company. We get to a market cap current of $2.6 trillion, book value of debt, $108 billion for total capital of $2.7 trillion. Now, a few things to note here, guys. Cash and cash equivalents is $73.1 billion. Now, if you include the long-term marketable securities, which is basically the cash that's invested for longer than a year, that actually works out to be $173 billion, which is incredible. Also, very important for our financial model, our terminal EBITDA multiple, which determines what the value is from the end of the model out into infinity. We have 17 times EBITDA. If you look, the mean of the comps is 16.9 times. Apple's currently at 17.7 times. So this is actually a very conservative assumption. Hey guys, if you're receiving value, please hit that like button. All right guys, the moment we've all been waiting for, what is Apple worth? We have our discounted cash flow valuation so we can figure out what Apple's worth. Is it undervalued? Is it overvalued based on our current assumptions? Let's hop in the model. All right, here's our DCF model. We start out with EBITDA. We subtract DNA. That gives us EBIT. Strip out the taxes. We got EBIT or NOPAT. We add back DNA. We then have changes in operating working capital and CapEx. That gives us free cash flow to the firm. We have our terminal value. Remember, 17 times terminal EBITDA. We end up getting our cash flows to discount. They're going to be discounted at these discount rates, 1 divided by WACC to the T. We get the present value of free cash flows. That gives us our total enterprise value of about 2.6 trillion. Now, we strip out the debt, we add back the cash, we get an intrinsic equity value of $2.576 trillion. Now, this ends up working out to be an implied share price of about 167 bucks a share. The current share price is about 169 a share, so it's actually trading at a 1.2% premium, which implies a sell rating. We obviously don't want to buy something for more than we think it's worth, and that's what we see right here with Apple. It's not a massive premium, but it is trading at a premium. It's basically at fair value for all intents and purposes. Okay, guys, the next piece that we're going to talk about, sensitivity and scenario analysis. Now, this is very important because one of the things that we do when we build a financial model is we don't just build one model. We build out data tables so we can see a range of values. So I literally have 50 models in this model. How? Via a data table. So I ran 50 different models and the majority gave us a sell rating, 58% sell, 40% hold, and only one of the 50 had a buy rating. Now, the three scenarios, bear downside, base steady state, and bull upside, are all covered in these analyses. Also, remember, Wall Street consensus is $200 per share. Let's hop in the model. Basically, what we do is we take two metrics. So I have revenue growth and CapEx intensity, as well as the terminal multiple and the weighted average cost of capital. What I then do is I put a range of 5 for each of those, 5 by 5, 25 different models. What do we ultimately see? Green means buy, yellow means hold, red means sell. The vast majority of these are a sell, even with super aggressive assumptions. Now, the last thing that we have to discuss in the financial model is the scenario analysis. What we're doing is we basically run each of the cases, the bear case, the base case, and the bull case. And what we do is we apply a probability, and then we determine, is it at a discount or a premium based upon that. And what we actually see based on an equal probability of upside, downside, and steady state, we basically get that it's at fair value. Okay, we have a very slight premium of 0.2%. Obviously, we don't want to buy something for exactly what it's worth. We want to buy something at a discount. So ultimately, this is something that we would not get into if we didn't already have some sort of exposure to. All right, guys. So in terms of the wrap up here, there is precedence with the lawsuit from the Department of Justice. And that was in 1998 when the Department of Justice sued Microsoft. Now, the case was settled in 2001 with Microsoft agreeing to change certain practices and, of course, pay a settlement. Now, there's some parallels here. In 1998, the case was brought about during the Clinton administration, and it was settled under the Bush administration. Right now, in 2024, we have the Biden administration. This is an election year, and it will take time to settle. Will it be a new regime or not? That remains to be seen. But don't worry too much. In the 3 years that the case took, Microsoft stock was up 69%. Versus 9% for the S&P 500. So basically, Microsoft trounced the S&P 69% to 9%, outperformed by 60%. Now, in terms of the case, ultimately, the Department of Justice is basing this on smartphones. Now, here's some interesting data points. 52% of Apple's revenues come from the iPhone, but it was 62% 5 years ago. Also, 5 years ago, 15% of revenues were from services, and now that's 22%. We're talking about iCloud, Apple Care, Apple Pay, the App Store, etc. So the company is actually moving away from a product-focused business and more towards a service-based business. So that kind of flies in the face of the DOJ lawsuit. Another thing to note, global smartphone sales. Apple, 23%, Samsung, 16%, Xiaomi, 13%. Now, to me, that doesn't seem like a monopoly, but case remains to be seen. Wall Street has a range of a high of 250, which is 50% upside, a low of 125, which is 25% downside, and a consensus value of 200, which is 18% undervalued. Now, full disclosure, I am personally invested in Apple. I don't plan on increasing my stake based on the findings of this analysis, but if it did pull back to like the 130s or 140s, I probably would. And what's the deal here? We're basically betting on Apple's ability to innovate. And with 170 billion plus of cash and some of the smartest minds in the business, I think that's a safe bet. Look at what they did with the personal computer, the iPod, the iPhone, the iPad, and now the Vision Pro. The possibilities are pretty exciting for a company like this. Now, if you like this and you want to see another Mag 7 tech valuation, check out my NVIDIA model right here. And also, if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.